There is an intersection between art and science, a place where data and research come together with instinct and experience. This is where Curate lies, where the science of knowing what to do meets the art of making it all come together.
What is to curate? To curate is to be the custodian of very important assets. Now that works very well with what we do because we do two things and we do them very well. Firstly, we take care of things that are important to you. We take care of our clients' wealth. And secondly, we give you the comfort of knowing that we've done really hard work to find the best people to manage your money.
In a world that's noisy and uncertain, we focus on simplicity. We don't claim to predict what comes next. Markets shift, narratives change, and uncertainty is part of investing. That's why we look beyond the numbers to find great people who embrace this approach of simplicity. In a world full of options, we aim to simplify. Our fund range is focused and intentional, carefully selected to offer relevant funds, managed by people we handpicked to take care of your money.
Just like you've trusted us, we trust the investment managers that we've chosen to take care of your money.
It's about thoughtful selection, not broad assembly, giving you a clear and considerate place to start. This is Curate, the art of investing.
Welcome to our first Exhibiting Our Investment Artist webinar. My name is Ali Simpkins and it is my pleasure to be hosting you this morning. We hope you enjoyed your introduction video. We have an exciting agenda today, but before we delve into the session, let me first address a few housekeeping matters. We've applied for CPD points. To make sure your attendance is verified, kindly watch the entire session and provide your ID number in the CPD section. Our event platform will be open until the end of May 2025 for you to still watch it and get your CPD points. Our event platform automatically emails you your CPD certificate as soon as you've watched the full session. Please feel free to ask any questions in our Q&A section. Our speakers will address them in real time or respond after the session. If the last few weeks have taught us anything, it's that no one can accurately predict what the markets will do or how global events will unfold. As investment managers, our goal is not to try and predict the future, but rather to make sure we help our clients navigate the choppy waters of the global investment seas. We don't know what kind of uncertainty is around the corner, but we know uncertainty is a guarantee. Therefore, it is important to understand that not everything can be placed neatly into a formula. The world is complex, nuanced, and constantly evolving, and understanding what tomorrow might hold requires more than data alone. It calls for fresh thinking, adaptability, and a broader perspective. Our next speaker has seen the future, and he loves it. To help us explore this and how we might craft for calm in the chaos, I'm honored to introduce our guest speaker. He's a futurist, scenario planner, and an expert at the future of work. With 6 best-selling books to his name and clients in over 100 countries, he helps organizations anticipate the forces that will shape their industries in the future and prepare for disruptive change today. In our session, he is going to show us how we can set ourselves up for success in this crazy, chaotic world we are in. From our studio, please welcome the CEO of TomorrowToday Global, Graeme Codrington.
Thank you, Ali. And it really is good to be with you talking about the chaos in the world around us and maybe going beyond the chaos and realizing it's not quite as chaotic as it first appears. Many years ago, an author, Ernest Hemingway, wrote a story, The Sun Also Rises. And in this fictional novel, 2 characters speak to each other. A young man asks an older man, "How does somebody go bankrupt? And the answer, and you might be familiar with this as a financial advisor, the answer was slowly, 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 and then very quickly. I think that that is a great summary of where we find ourselves in the world. This is that graph, right? It's that slowly, 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 and then very quickly. Sometimes the economists call this the hockey stick graph. And, well, you're an advisor, you look at numbers all the time, you'll realize that this graph has no axes on it because it could actually refer to many things in the world at the moment. For example, a graph that shows average life expectancy. Over the course of human history, most people have lived into their 50s. In our lifetimes, life expectancy has been increasing. You might not believe this, but life expectancy is increasing at 1.5 days every week. If you make it to Saturday, and I don't know what kind of week you're having, so maybe it's an if, but if you get to Saturday, you will have added another 1.5 days to your life. Sadly, you can't take it this weekend. It gets added right at the end. But what that means is, if you're in your 50s or 60s, you should expect to easily make your 90th birthday. If you're in your 20s or 30s, you should be planning for 100 years. Now, this hasn't quite yet made it into our financial planning world yet, has it? Because slowly, 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 and now very fast, life expectancy is a good example of that. Another example could just be the natural world around us. This could be a graph of average world temperatures over the last few hundred years, where basically we've been in a good balance with the world around us, we being human beings over centuries. But again, in our lifetimes, we have begun to see a dramatic uptick in a number of fairly alarming factors. You can see in the graphic here, it could be extreme weather conditions. Let me give you some actual numbers related to that. Just 15 years ago, the United States experienced a $1 billion extreme weather insurance event. Okay, that's a bit of a mouthful, but a tornado, a hurricane, a fire that had more than $1 billion worth of damage. That happened about once every 18 months. That was 15 years ago. In 2023 and 2024, one of those happened every 26 days. Slowly, 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 and then very quickly things change. So whether it's extreme weather or temperatures, average temperatures getting higher, whether it's rainfall, if you're in Gauteng, wave a little flag above the wet weather that we've had recently, whether it's in pollution, air quality, plastic pollution, whether it's just in the impact of pandemics. Can you believe it's the 5th anniversary already of all of that lockdown? We are at a time where we are experiencing things like aging that no human has ever experienced before. That's quite a thought, isn't it? That we are living at a time in history, at a moment in time, that no other human beings have ever experienced. One final example of my slowly, 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 then quickly graph could be computing power, technology. Now, this one, if you know anything about Moore's law, this one might be a little bit incorrect because computing power has just been increasing, doubling in capacity every 18 months for all of our lifetimes. So maybe it's not so much computing power, but more the hype related, especially, of course, to generative AI over the last 2 years. But however we look at it, we live in a world of deep structural change. That's my definition of disruption. It's not just that things change. Things always change. Things have always changed throughout history. But right now, where we find ourselves, we are experiencing unprecedented shifts in every part of society, from politics to economics, from culture even to religion. We are seeing things change dramatically. I don't think it's an overstatement to say that we find ourselves at a crossroads in human history. Historians will look back and study this moment in time. But this is the point of this webinar. I don't think it is quite as chaotic as it appears. If we keep our eyes open, if we remain focused on the important stuff, that crossroads is actually plotted on a map. And I want to show you what I mean. Because if we understand the map, if we understand the direction in which this change is taking us, that's going to obviously allow us to be just a little bit calmer, maybe, than some of us are at the moment. And when it comes to thinking about our money and our investments and our planning for retirement and our wealth management, well, a little bit of calm is going to go a long way, I would suggest. So let's craft a little bit of calm in the chaos of all of this change. And I want to suggest 3 examples that will help us. If we had the whole week together, I could give you 100 more. But let's pick just 3 to prove this point that I don't think it's quite as chaotic as it appears. The first of those, let's call it geopolitics. And if we're talking about the chaos, well, then we've got to go to, I suppose, a possibly surprising place. Who knew that America could just go crazy as it has gone? Donald Trump is not even president for 100 days yet, and he's moving at pace. I don't know you might not even know me, and we don't have a chance to discuss this over a good biltong and braai. So I'm going to be a little bit careful to not be incendiary in my comments about the American president. But whatever you do or don't think about Donald Trump, let's give him at least this little bit of credit. He told us what he was going to do. He's doing what he said he would do, and he's doing it with gees. American. He's doing it with gas. Foot to the pedal and pedal to the metal. And yeah, a lot of things did need changing. The systems were not delivering a better life for all. And he promised that he would come in and blow the system up and then see what would happen with the pieces and see what we could build after that. If you haven't heard of it, it's called Project 2025. It was put together by a group of people in a very conservative think tank called the Heritage Foundation. It's a 930-something page document. You can download it. In fact, I'll make your life a little bit easier. Go and check this website out, project2025.observer. It's a literal real-time tracking of the over 300 commitments or focus areas that the Project 2025 document had, and it tracks how Donald Trump's administration is actually implementing them. Now, the reason I say this is my team, which is essentially a team of researchers looking at the future of work, we've been tracking this for a long time. In fact, more than 8, 9, nearly 10 years ago, our team actually predicted that Donald Trump would win that first election. That was a very unpopular and fringe opinion back then, not because we wanted him to, but because we just had a sense that his message of change would resonate with the average American. Not the average wealthy American, but the average American. And we were right, and we were right again when we predicted he'd win this second time. And that Project 2025 is the plan. And those people, like myself, who have been watching the plan and reading the plan, maybe we're surprised by the speed and the depth of feeling behind some of the things, especially the anti-foreigner and anti-Palestine views, but we're not surprised. And that's part of the key, right? If we are needing to keep our eyes open to see what's changing in the world, well, then we need to keep our eyes open and not just hope that the world keeps going the way that it was, but realize that in this world, the world of 2025, where we have global technologies, where we have globalization and international media and the reach of global institutions, it is in fact possible for a small group of people to make a very big impact and change in the world. We know what Donald Trump's trying to do. We can track him doing it in real time. And if we've got our heads screwed on well, we'd be able to anticipate what he's going to do next and what the impact that will be on our industries, our markets, and our investments. But I don't want to just get stuck in America, because if you understand Project 2025, well, let's go to the other side of the world and look at another country that's also had a Project 2025. Just a few weeks ago in China, they held what they call their Two Sessions Conference. Now, this is as important, if not more important, than what happens in the White House every week. But have you heard about this in the news media? I haven't really. You've got to be quite switched on to realize what's happening in Chinese politics. But here is what happens in Chinese politics. Every 5 years, the Chinese government sets out a plan, an agenda for the next 5 years. They are currently just finishing their China 2025 plan. It's their 14th 5-year plan since the starting of the People's Republic of China. And did you know this? That in the last 14 5-year plans, China has hit every single target they've ever set for themselves. They build it into their constitution. It goes all the way down to the local municipal level. And when they commit to doing something, they deliver. And they hold themselves accountable for doing it. Wouldn't that be wonderful if we lived in a country with a government that would do that level of detail? And just a few weeks ago, China released their 2035 plan. It's probably too small on your screen to read. That's not the point. You don't have to look at the detail. But just to show you, there is detail available. Quick Google search and you'll find the China 2035 objectives. And by the way, they've also released their China 2049 plans, which will be the 100th anniversary of the People's Republic of China. The reason I'm telling you this is because the two biggest forces, the two biggest countries, the two biggest economies in the world are both very clearly telling us what they plan to do. They're giving us the roadmap. And if we're prepared to take the time to read it, we'll know where they're going. What's actually happening is this, that we live at a moment in history where the existing systems, the systems that we live in the West, mainly democratic capitalism, in the East and Russia and India, a more socialist, even communist view of the way that we can put a country, a world together that delivers a better life for all. But whichever system it is, whichever country you look at, almost all of the systems are failing to deliver. I don't know about you. I'm finding it harder than I thought it would be. I'm in my 50s. I've got 3 kids. They've gone through school. I've got a great job that's very stable. I love what I do. But it's harder than I thought it would be. By the way, I've got parents who are not leaving me an inheritance. I'm needing to help them. All my black friends are laughing at me because they say, hey, you white guys are suddenly discovering black tax, as I've got to help my own parents. My oldest daughter, 26 years old, still not off the payroll. It's not her fault. I'm not criticizing Amy at all. It's the nature of the world. More than 30% of 25-year-olds are still reliant on their parents. That's a global statistic, not just a South African one. The system isn't working. And in our lifetimes, in the next 5 to 10 years, new systems will emerge. That's part of what's driving the chaos. But if we understand what's driving that chaos, I think it can bring us just a little bit of calm. It's not that South Africa's gone crazy and all hell's been broken loose here. It's all over the place. It's not that everything's broken. It's just that the old systems are no longer fit for purpose and something new is trying to emerge. It's not that there's complete randomness in the system. It's that we are moving to a new system. And if you're dealing with long-term wealth management, and if you're dealing with retirement planning, you kind of got to get your head around that. But when you do, you realize it's not quite as crazy as you thought it was. Right, but now let me get to my second point, which is technology. We live in a world dominated by technology, and we call it artificial intelligence or generative AI these days. That's ChatGPT, Copilot, Grok, what the others, Bard, Claude, Bing, whatever version you use, or Meta AI. Unfortunately, it's not artificial intelligence. It's not even close to artificial intelligence. It's actually quite a dumb system. It is the most powerful tool we've ever created, but it isn't intelligent. I want to prove this to you. Now, as you're watching this webinar, just grab whatever device you've got that's got a generative AI feature on it. So your easiest way to do this is open WhatsApp, and down in the bottom corner of WhatsApp, there's a little circle. And if you click on that, that opens up Meta's AI system. And that will allow you to generate text or images. And what I'd like you to do is I'd like you, while I'm talking, to see if you can, using ChatGPT or Copilot or Midjourney, whatever you want, see if you can generate a picture of somebody writing in a journal with their left hand. Okay, so literally this picture, okay? So you just say, imagine or create a picture for me. Now, don't do a Google image search. You could find this picture. I want you to generate it using one of these generators. Now, you are not going to be able to do this. I can pretty much 100% guarantee you can't do this. And while you're trying, I'll explain why. But to do that, I have to tell you that I'm a little bit disappointed with technology. I'll be honest. I use an iPhone. I'm a huge Apple fan, and I've got an iPhone 13. I haven't upgraded it for a number of years because I haven't really found a reason to upgrade. Last year in September, they came out with the iPhone 16. And I thought maybe this is the year I'm going to finally upgrade my phone. And I'm a bit of a nerd this way. I love technology. And so I actually literally stayed up late into the night to live stream the iPhone 16 launch. And they said there are 3 new amazing features to the iPhone 16. The first of those is that it has an extra button. An extra button. Wow. Well, tell me, what does this button do? I mean, it's the iPhone 16. Surely if I click this button, all the traffic will disappear. They won't just tell me there's a traffic jam. It'll clear the traffic for me. Maybe not. If I press the button, maybe it will cure cancer. I mean, it's 2025 already. These things should be curing cancer. But no, what did that extra button on the iPhone 16 do? It accessed the camera slightly faster. Do you want to know how fast I can access the camera on the 13? That was it. Access the camera. On the iPhone 16, no, it wasn't a wow. Anyway, the second thing that was supposed to be a wow was that the camera was slightly better. The iPhone 13's camera, 3 multiple lenses, I don't even know what the megapixels are, but it's way more than I need. And the 16 is a little bit more than that. So I've gone from more than I need to even more than I need. Okay, well, at least the third thing must be super smart, right? And the third innovation, the third revolutionary change, and I'm not joking with you, I'm not making this, go and watch the launch event, was that it came in purple. I'm sure they didn't call it purple. This is probably Steve Jobs' nose hair color. I don't know, whatever color they called it. But literally those were the 3 innovations. Are they joking? Are they joking? Now, you might think, hang on, what's just happened to this webinar? I thought Graeme was very upbeat about the future. He looks like a guy who knows his technology. I'm not against technology. I am against the hype. the hype that says suddenly we've got artificial intelligence and we should be all scared that it's going to take over the world and it's going to do things to us that we can't believe. Have you been able to get a picture of somebody writing in a journal with their left hand yet? Let me explain why you haven't, because I bet you haven't. By the way, in case you want to try this, ask it for a picture of a full glass of red wine. But when I say full, like I mean full to the top. It will give you a glass that's half full only. Ask it to give you a picture of an old-fashioned clock and tell it what time should be on the clock face. And whatever time you tell it, it will give you 10 to 10. Irrespective of what you ask. Here is why. It doesn't actually understand what you're asking. I won't go into the detail, but if you are a technology nerd like I am, generative AI works with something called tokenization. It doesn't actually understand the words that you are speaking. It takes your words, it turns them into, let's call them emojis, little images, tokens. It then puts them into it's not a database, it's an engine of every piece of information that has ever been known, right? And it then takes that information and it basically just uses a probabilistic engine to try and predict the end of the sentence. Okay, that's a lot of words. To just say it doesn't actually understand what you're saying. It didn't know that you asked for a left hand. It doesn't know what a left hand is. It doesn't know what a journal is. It just knows that when you ask it to give it a picture of somebody writing in a journal, it can go and find thousands of pictures that have got that label. It doesn't know what that picture is, but it knows that that label is. And you know what? 99.9% of all pictures on the internet of people writing are right-handed. Apologies to you left-handers, you know that you are a minority in the world. So it cannot produce a left-handed picture, even if you push it and force it to. 99.9% of all pictures of wine glasses are half full, because you don't really fill a wine glass to the top. But if you ask it to do it, it doesn't know what you're asking. By the way, just recently, about 3 weeks ago, ChatGPT upgraded its ability to put text into images. I hope you can see this on your screen. I asked it to put in the text of the journal, "It was the best of times." Look what it did. It literally just wrote, "It's the best of times," like it's an alien who doesn't know what's actually going on and it just dumps the text there. So then I said, no, hang on. This is supposed to be upside down, the other way around, facing the person writing it and only on the one side. And then finally it just flipped the whole picture and gave me gobbledygook again. Okay, that's a long way round to say to you, AI, generative AI, all these apps are amazing, but they have a very limited application. They are brilliant for the things they have been designed to do, which is to take everything we already know and finish your sentence. But when you start to use it to try and predict something or make a values judgment, or even worse, try and have a moral outcome, it's as likely to give you nonsense as it is to give you fact. Let me call it hallucinations. Let me maybe approach this a different way. If you could have all the data, imagine you could have all the data for all of your clients, everything they ever do, all the things that they do in their lives. What would you do with that data? That's essentially what we should be thinking about when we think about AI. It's just a big database, which allows us to spot patterns and come up with insights around those patterns. By the way, I mentioned my daughters. When I ask them this question, and when I ask young people, they come up with really cool ideas. I think the best idea I've heard from my daughters and their friends is, if I had all the data in the whole world, what would I do with it? I'd create a ChatGPT that would allow us to understand what animals are saying and even speak to animals and let them understand what we are saying. And by the way, this is where it becomes a little bit difficult to do my job, because I gave this example and a few weeks ago somebody came to me and said, They've already done it. Apparently, at a Canadian university called Dalhousie, they've actually created, can you believe this, Chicken GPT. They genuinely believe they've got a model that allows them to understand what chickens are saying with all that noise. And if the chickens are hot or cold or hungry or thirsty, they can understand what the chickens are saying. Can you believe it? Well, I can believe it, because that's kind of the promise of AI. It's a massive pattern recognition machine. But I prefer to think of it as IA, not AI, not artificial intelligence, but rather intelligent assistance. And here's the cool thing for you. I don't think that AI is going to replace us. I don't think that AI will replace financial advisors or wealth managers or whatever label you use. But I think that wealth managers who use AI well will replace the wealth managers who don't. That's where we find ourselves. Not in this crazy, chaotic world with massive new intelligence that nobody understands that's going to change everything, but rather we've built ourselves a remarkable tool that's brilliant for the things it was designed to do. And if you know how to use it well, it will give you a competitive edge. It's not quite as chaotic and crazy as it first appears. Final point, and I'm nearly done, is I think in all of this, what we really need is, rather than fear or nervousness or just freezing in the face of chaos and change, we need to rather, maybe even paradoxically, realize that in the middle of all of this craziness is the greatest opportunity in the history of the world. Two simple examples. In South Africa, we've been dealing with load shedding for 15 years, by the way. But it was only about 2 or 3 years ago, when we got to whatever stage 8 it was, that everybody just said, okay, enough. We now have to do something. And over the last 2 or 3 years, we have been the country that has had the most increase in solar installations of any country in the world, by the way. It's absolutely astounding what's happened. And now, of course, we've been able to deal with load shedding largely, actually, not because Eskom sorted themselves out. They did a bit, but mainly because we don't need as much capacity from Eskom as we used to, because we've put solar panels on our roofs. We looked at the chaos and we did what every decent South African ever does, which is to say, okay, we'll do something. Make a plan, make a plan. We do. Another maybe more recent example. Donald Trump and his trade war with Canada. The Canadians responded like Canadians do, to say, okay, if you want to fight with us, we just won't buy your stuff. Literally, Canadian stores took American liquor, in particular, whiskey and wine, off of their shelves. Do you know what happened? 3 or 4 wine farmers from the Western Cape were on a plane the very next day flying to Toronto to go and meet with some of these supermarkets to say, would you like some decent wine and whiskey and brandy? We can sort you out. In every chaotic moment, there is opportunity. In every piece of craziness, there's an opportunity to find some calm. And what we all need to do is actively seek out that reframing of how we think, so that we can see the world, yes, not ignoring all of the change and disruption, but recognizing that, in fact, there is a bit of a map and it can be followed. And then probably in the context of curate and in the context of wealth management and in the context of investments, we need to just bring a little bit of that calm to the way we deal with our investments. You can ride the ups and the downs, and if you're lucky, you can make a little bit of money. But that's not really how we build wealth, is it? We hold the line, we go the course. And I suppose probably the best thing we do is partner with people who spend their lives, every waking moment, sometimes even their dreams, thinking about this map and where it's taking us, and making wise, curated decisions about where we go next. We've got to build a group of people we trust, keep our eyes open, and hold the course. That's how I think we craft calm in the midst of chaos. Thank you.
Thank you, Graeme, for challenging the way in which we should view the future. Next up, Ray Mere, the CEO of Curate Investments. He's here to set the scene and introduce you to South Africa's newest investment manager, illustrating the art of investing. Over to you, Ray.
Thank you, Ellie. Firstly, a heartfelt thank you for joining us for our first Exhibiting Our Investment Artists webinar. And to everyone who has engaged with us, supported us, or even liked one of our social media posts since our launch late last year, we truly appreciate it. Your interest and support mean a great deal to us, and we're excited to continue this journey with you. As you might have already seen, our tagline is The Art of Investing. We are of the belief that investing is an art and a science. Steve Jobs talked about it all the time, promoting that Apple was building at the intersection of art and technology. The technology we hold today in our hands was no doubt groundbreaking at the time, but Steve ventured one step further, striving for the products that he imagined would become so deeply integrated into our lives to also be beautiful. That's not the technology, that is art. Another example given by popular author Morgan Housel would include car manufacturing. Building cars is the science of engineering, but designing cars is the art of curves and lines and beautiful colors. There are many more examples that come to mind, but to bring it back to investing, yes, it might be grounded in analysis, data, and process. However, it must also be shaped by experience, instinct, and a deep understanding that investing cannot be neatly placed into a formula. Gathering information is science. Filtering out the noise is art. We are inspired by navigating this intersection and aim to craft for calm in the chaos by building a global offering that is simplified, relevant, and doesn't compromise in excellence. Our principles are anchored by the fact that to curate is to choose carefully. There's a fundamental difference between assembling and curating. Assembling often means more data, more options, more complexity. It's additive by nature. Curating, on the other hand, is selective. At Curate, that's the essence of what we do. We handpick the best people to take care of your money. As a global business, we research managers worldwide to find the people we believe are most suited to delivering on what you require. Curate's disciplined and rigorous selection process seeks out outstanding investment teams wherever they may be across the world. We're thrilled to be able to bring you investment management pedigree from New York, Boston, London, Rotterdam, Cape Town, and of course, Johannesburg. Through these partnerships, we're able to offer our clients access to single managed unit trusts, which offer client-led solutions, including reliable income solutions, capital growth strategies, and international hard currency and rand-denominated options. The cash and income funds managed by Momentum Fixed Income are ideal for clients seeking capital preservation, liquidity, and income. Our balance fund, managed by Visio Fund Management, blends growth and stability for medium to long-term objectives. And our property and equity funds, managed by Sesficule Capital and Lorium Capital, respectively, are designed for long-term capital growth needs and both have a combination of local and global assets. Robeco's Global Sustainable and Emerging Market Equity Funds, also available as feeder funds, offer broad-based developed and emerging market equity exposure at low cost. And the Global Value, Growth and Quality Equity Funds explore different equity styles. In summary, these are our Curate funds. Each Curate fund is managed by one specialist manager, ensuring focus and precision. We identify them as masters of their craft. People that have clarity of purpose, deep knowledge, experience, skin in the game, and they go beyond the numbers to take care of your money. To us, that is the art of investing. Thank you.
Thank you, Ray. Investing sure does lie at the intersection of art and science. Next is Patrice Moyal, the CIO of Visio Fund Management and a portfolio manager of the Curate Momentum Balanced Fund. Patrice will highlight some of the anchoring characteristics of Visio's people, philosophy, and processes. Welcome, Patrice. We look forward to hearing your insights.
Good day. Thank you, Ellie. Thank you, Curate, for the opportunity once again to present what the fund is all about. So the Curate Momentum Balance Fund is one of our key instruments in terms of ensuring that we cover a number of different factors in order to pretty much take care of the best form of investment opportunities that we see out there, to take advantage of as many opportunities in the most measured manner in a balanced format, multi-asset, meaning both domestic, offshore, fixed income, property, and in obviously a strategic allocation format. So just briefly, the key portfolio managers within the fund: Jonathan Myson, who heads both the strategic allocation aspect of the fund and is also head of the fixed income part of the fund. I am responsible for the overall equities positions within the fund, and we are guided by Jonathan and his team in terms of the strategic allocation. And Mpegelo is second in command in terms of the equities opportunities, with a greater focus on the SA aspect of the portfolio. Now, in terms of the unique characteristics, if you can call it, no one is unique really, but I think that our background in hedge funds over the past 20, well, my background over 27 years, and Visio's background as the manager of the fund since 2003, so that's 22 years now. Our background was in hedge funds, and hedge funds is all about mitigating risk and preserving capital. And it goes without saying that at the end of the day, the best way to generate returns is to lose the least amount of money. And the returns will come thereafter from avoiding as many losses as possible. And it's never been more pertinent as it is currently right now, with the amount of volatility in the markets, with what's happening around tariffs, Trump administration, and geopolitical risk. And when we say we invest with a margin of safety, it's once again not something that you can kind of measure, but it's again focused on our primary mindset is how much money can we lose on this investment? What is our margin of safety? What is our downside risk? And if you can, at best possible, avoid some of the downside risk, returns will take care of themselves. And in saying that, we will therefore tend to avoid popular stocks in many instances. We potentially will not make as much money as others when markets are flying. But on the other hand, when markets are dropping and when there's a lot of pressure around, we tend to have a far more resilient portfolio. And obviously taking into account the strategic allocation framework, which also drives our overall stock selection and fixed income selection as well. And obviously geographically, more or less within a South African context or a global context. If we look on the next slide, it's again, we launched this fund in 2024. We launched our hedge funds in 2003. And in the last 22 years, we've had many, many instances of incredible volatility. My background goes back to 1997 at Liberty Asset Management. And again, I've seen since then enormous amounts of crises and some market collapses, etc. And so been there, done that, got the t-shirt, not our first rodeo. And thankfully, we have quite a lot of scars on our back to guide us along the way, even especially at the moment. What I can say is that as of this month, as of this year, our fund is performing well better than the market overall. As you can see on the graph, one cannot predict from month to month, from year to year. So at the end of the day, as I said again, it's all about capital preservation and ensuring that you do not bet the bank on anything as such, and approach in a very measured way. The experience within the Visio team speaks for itself, and the different, let's say, well, not so much degrees, but the variety of academics backgrounds allows us to really pick from different brains and look at not just numbers as a CA would do, but look from an engineering background. We have two chemical engineers, so they very much look at things in a different way, strong on mining, for example. We've got mathematical masters, which also tend to think a bit more differently and look at things in a different manner as to the way an accountant would look. But essentially, at the end of the day, it's good to have the variety. It's good to we have a member of the team who is in the US, Justin Froneman. Douglas is in Australia, and I travel a lot more between Europe, Israel, and South Africa. And that all helps in terms of really broadening our knowledge, our experience, our network, and getting to experience different perspectives from many different geographies, different people, and actually almost switch out sometimes of the day-to-day and allow us to think a bit more deeply about what the real issues are. So that's the team. In terms of the makeup of the fund, this is a little bit misleading in the sense that, as we all know, South Africa is essentially 65, maybe 70% global, with a very strong penchant on China, with Naspers process making up 15 to 20% actually of the market. And thankfully for that, because it's been an incredible performer for all pension funds in South Africa for 20 years, since 2003, when Chris Baker made his first investment in China. But we also have the likes of Richemont, we have British American Tobacco, we have the mining stocks, a number of other companies that have really no bearing on South Africa, but thankfully are listed in South Africa. So when we look at this, the geography really doesn't really depict the true makeup of the fund. Even the USA, you look at a stock like Microsoft, where more than 60% of its earnings actually are derived from the rest of the world. Like it's 70% of its earnings are derived from the rest of the world. And that little caption there on Belgium, Belgium is a listing in Belgium that is Universal Music Group that actually sells music around the world and makes very little music money in Belgium itself as a proportion of its total earnings. So this is really just where the companies are listed. But again, it's important to just give you a perspective that we do look at companies in many different places. On the next slide, this is the diversification by sector. That's certainly more telling, and that really does break down the portfolio better. And you can see that it's very well diversified. We do not have an over dependence on technology, which has been a very big driver of growth globally, certainly from the US. We have a slight affinity to what we call insurance, which is probably disproportionate to the overall global MSCI index, but that is focused on the pensions risk transfer market in the UK in the form of all these defined benefit plans that are moving on to the writers of annuities, in essence, reducing the risk in the UK for all their defined benefits and being taken over by the likes of insurance companies like Legal & General, Renet, which is a South African listing, through PRC, Pensions Corp rather, and then Just Group, which is another small listing in the UK, has done very well for us. So I mean, these are just very key sectors. As I said, we're not massive fans of insurance at the best of times because of the accounting difficulties for understanding insurance numbers, but overall there are some really good opportunities in that space. Same with financials. We like the likes of Alexander Forbes, has done very well for us. We continue to think that it's a corporate event opportunity. So there's very specific stocks. We don't tend to migrate to the index. We tend to look very much bottom up, and our focus is therefore much more company specific. And then again, is something that we've done for many years. We are very much involved from an activism point of view, shareholder activism. We write a lot of letters to boards. We don't make it all public. Sometimes we've gone above the radar. At most times, we tend to really concentrate on engaging with boards, gauging their willingness to engage with shareholders, and to unlock value where value should be unlocked. In other instances, it may be we don't think management is that well incentivized and should be better incentivized in order to ensure that interests are all aligned. So letters can be very different in their content, but it allows us to get more understanding of companies, to take bigger percentages in the funds of those companies, and to gain greater comfort. So in many instances, you won't see those letters, but they are very constructive, and they've allowed us to generate outperformance in our funds thanks to this additional level of comfort and information and understanding that we have of companies and the playmakers within those companies. The next slide is from a fixed income perspective, so not equities, but fixed income, geographic and asset classes versus, and you'll see that it's obviously very much South African based. I think it's important given that we are at the end of the day addressing a South African investor. We are very cognizant of the South African investors' needs within their own wealth management framework. And so we will tend to very much concentrate on domestic fixed income opportunities. We are not oblivious to some very interesting corporate debt opportunities around the world. We invest in corporate bonds. We've been doing it for years. Sometimes it's a better option than a share itself. So these from time to time will come into the portfolio. We will treat it more like an equity than a bond, such as, for example, in COVID time, we bought Sasol bonds at 55% of face value. And, Sasol wasn't going to default, and we got close on 100% of that bond. In other words, we paid 55 rands, 55% of 100 on those bonds, and Sasol bought these bonds back at 100%. So that was an equity-like return from a corporate bond, from a fixed income type instrument. So we have a very large radar of these bonds that we look at. And when credit spreads are widening, given like they are currently, we are, paying close attention. If you can get 8-9% in dollars on some bonds right now, they offer a better return than equities, in all honesty. On to the next slide, is SA cheap relative to history? Yes, it is, and we all know the reasons. Unfortunately, it's even cheaper if you strip out the international stocks that form part of the slide. On the left graph, it'll be a PE that could even be sub 10 at this point, judging by some of the companies that we're investing in. It's even sub 7 times. So it's ridiculously cheap, but it's unfortunately, there are no clear catalysts as to when the tide could turn, other than what we call corporate events and corporate action, where eventually the boards themselves and the CEOs think, well, we're not getting a rating. Our listing has no merit, and therefore we need to delist, or we need to buy back shares, or we need to break up the company. So that's how we see the cheapness of South Africa, is in terms of how value will be extracted. And we can't rely on outside factors like government policy, etc., because we can see that to date hasn't really worked. P ratio of the US, it is tending towards expensive. We know why. The Max 7 have already rated quite highly, but that's coming down because of factors outside of their own earnings capacity. But with the global ructions currently underway, we will tend to be a bit more, cautious and selective, and we have done so already. And interestingly enough, we are focusing our attention on pure US companies, so not so much the global ones, but things like General Motors right now, or those generating electricity or selling electrical generating equipment, such as GE Vernova, etc. So this is where we're seeing opportunities. They may be expensive, but they have a very long pipeline of order books or projects underway to create a lot more electricity. For example, in the US, they are essentially shielded from tariffs because they source in the US, and it's a very much a necessary sector in the US economy. They need electrons, as they call it. They need many, many electrons in the US to allow them to manufacture more. The data centers, and they've just fallen behind completely in terms of electricity generation relative to China, for example. The asset allocation within the fund on the next slide, I think this really just shows that we can at times stray from our strategic asset allocation. As you can see currently, we are very much doing so. We are very underweight global equity relative to what would be strategically the correct allocation. So we've taken a view to actually be rather circumspect in terms of our global equity. It's paying off at the moment. You've seen what's going on, but South Africa, on the other hand, hasn't been left unscathed. So we're not exactly being heroes here. We are just simply being a bit more cautious, and at this point, trying to at least focus on the geography where we have the most control and stay a little bit underweight where we want to just see how things play out. We have edged back into global equities the last couple of days slightly, so that 12 is a little bit more. And in terms of going forward, we will continue to do so. We're not oblivious to the value that's becoming apparent overseas, but we don't want to jump in full guns at this point. So by this gives you a sense that we apply a lot of discretion, and we're not scared to stray if we have to. That is really the mantra of a hedge fund, is to really not be conventional. And obviously always focused on capital preservation. I want to focus on this slide a little bit. This is the South African stocks. You'll be familiar with most of them, or hopefully all of them. In every instance, firstly, the weightings are those of the fund overall. If you take those weightings as a proportion of the equity component, it's actually, you can add 1.5 times to almost 2 times. So you can see we have concentrated portfolios. These may be rated is at 80 billion rand or 75 billion rand market cap right now, so it's quite big. On the other hand, some of the other targets is quite big too, but some of the others are quite small. Invictus, CMH are below 4 billion, but incredible value. Management's buying back shares in Invicta, the company's buying back shares. Interested shareholder in Christo Visa has a large portion of the company. There's incredible value here. Engineering Group really generates a lot of cash, trading at a discount to its full value. So we really see great opportunities here. We are well invested there, and we are working with management to see what measures they can follow or adopt to really either take the company private or keep buying back shares cheap. So in every instance, we are engaging with the boards, engaging with management, and there are others which are not featured here. It's really where we can add value to our holdings. And as I said, we do it under the radar. We're fairly circumspect. There's no point in antagonizing boards or management. On the next slide is our global investment themes. I'll tell you, the list of opportunities is growing now, day by day. These have been our core holdings of late. And in every instance, it addresses what we think is a long-term sustainable demand. Microsoft is more like a utility. You use it, you pay for it every day. Everyone does. It becomes almost a sunk cost. You don't really even notice what you're paying, and it's there because you use almost all of use their functions just in every aspect of your normal working day. And then on the right, I mentioned the energy generating companies, AES, Evenlode, 2 outstanding companies in the US. Striker, Teva. Teva is new, more recent. It's fallen a lot, but it's a key producer of generic drugs, actually Israel-based, but most of its business obviously is international, with a large portion in the US, so we're being a bit cautious now. We're going to see what these tariffs look like for pharma groups, but generates good cash, long history, and it's coming out of a very difficult period, so therefore the opportunity. Striker is the #1 player in the world in medical devices. It's a blue chip, and it's year in, year out generated a very sound growth, and we and it's something you cannot really disintermediate. Medical devices, physical medical devices, hip replacement, and all sorts of things. It's really a very solid, well integrated business. We're very big believers in the AI space and the digital transformation, and therefore the importance in having TSMC as the cornerstone. I know there are risks to Taiwan, but if something happens to TSMC, we're all in big trouble. And TSMC is trading on a very attractive multiple, even cheaper now, and it is really just one of the best businesses in the world. So in a nutshell, without taking more time, I just want to say once again, thank you to Curate. I hope I've covered most aspects of what we're about, and to also give you comfort that number one, we're looking after your money as cautiously as possible. We are looking for returns, but we won't do it with undue risk. We have the tools, we have the history within Visio. The fund allows us to really aggregate all of what we do in the best way possible and express it in our best way possible. And we are once again very honored and privileged to be able to do this for Curate's clients. Thank you.
Thank you for the great insights, Patrice. To summarize, the Curate Momentum Balance Fund offers investors a compelling solution for long-term wealth creation, backed by an experienced investment team with a disciplined approach to navigating changing markets. The fund is well diversified across asset classes, sectors, and geographies, balancing local and global exposures with allocations to equities, fixed income, and other growth assets. This diversification, combined with dynamic asset allocation, helps manage the downside risk while aiming to deliver high potential returns over time. With a moderate risk profile, the fund is Regulation 28 compliant and well suited for retirement annuities and preservation funds. Back to Ali to introduce our next speaker.
Thank you, Ray. James Noodler, a portfolio manager at Evenlode Investments in the UK, will now demonstrate how they build resilience and find opportunity in an uncertain world for investors of the Curate Global Quality Equity Fund. Welcome, James.
Thank you very much, Ali, and thank you very much for joining us today. My name is James Noodler, and I'm here to talk to you all about the Curate Global Quality Equity Fund and who we are, what we do, and what we offer to our investors. And the title for today is The Quality Compounders, Resilience and Opportunity in an Uncertain World. This title was chosen a little while in advance, and interestingly, the world has become more uncertain than ever since it was chosen. Anyway, who we are, what we do, and what we have to offer. So we are Evenlode Investments. We've been around since 2009, and the portfolio managers on this fund are shown on this slide. Hugh Yarrow, off on the left, is our co-founder. He set up the business in 2009. He is the curator of our philosophy and our process and our culture. He has a wealth of experience in the investment world, having started in 2000. And he has day-to-day oversight of all the operations of Evenlode. And working on the fund day-to-day, myself, Christina Dyer, and Chris Elliott. And one of the themes of today, I understand, is investment is both an art and a science. Evenlode has had this from the start. Hugh is a philosopher by his academic training. His co-founder, Ben Peters, is a scientist who's actually working as a scientist at Oxford University when he set the firm up. And if you look at the people on the slide, our backgrounds, I actually have a degree in English from Oxford. Christina was a scientist at Oxford, and she had just finished a PhD in immunology when she joined us. And Chris Elliott is by training a mathematician. He was at Cambridge. This is a balance which runs all the way through Evenlode. We tend to recruit people both with very strong humanities backgrounds and very strong scientific backgrounds. And there's a recognition that no one side on its own is sufficient to deliver the kind of service you need in this industry. You need both. And a little bit on what we do day to day. We're based out of the countryside in England, just as a legacy of where we were set up, a long way away from the noise of London and New York. But we invest globally. And we've always had the same principle, the same process, the same philosophy. And the principle, the motivation, the rationale is to preserve and grow the wealth of our clients. We are our own clients as well. And this slide slide 4, gives you a bit of detail on the setup of the firm. And the thing I would really like to stress, obviously we've got to a decent size over time. It has all been an organic process. The philosophy is unchanged. And one of the things underpinning it, which is absolutely critical, is that we are owned by an employee trust, which is unusual in this industry. I think perhaps unique. And the structure of the employee trust is that all the current employees are beneficiaries of that trust. And the point of this is to align ourselves with our investors and to give ourselves the framework to roll on perpetually. We believe small is beautiful. It makes sense to be a boutique. We also believe that being a boutique has its own challenges in terms of handing on control and prolonging the life of the business by bringing new people in. And the trust structure is a way of addressing this. And then a little bit on the strategies we manage. So as mentioned, we were set up in 2009. We have never changed the bedrock of what we do. We invest in companies we define as quality. We'll get into that in a little bit, which are available at sensible valuations from the stock market. What we have done over time is we've gradually relaxed the constraints that were initially imposed on us. So the initial constraint was we would invest principally in the UK, and we would provide our investors with a dividend distribution every year. Over time, we've become comfortable in our knowledge of a pool of wider companies globally, and we've added a global income strategy. And then over time, given that we are very focused on the bedrock of dividends, which is free cash flow, we became comfortable we could offer a strategy which did not offer a distribution. And that's the one I work on, the global equity strategy. And then as of last year, very excitingly, we have joined forces with Curate to make our strategy available more globally. Historically, we've been very UK-centric in our client base. And as mentioned, the down escalator piece is critical. In our experience, our hit rate, the number of companies which stay in the bar at the top, is meaningfully superior to that of the broader market. So our companies are in the down escalator at about half the rate that you see here. That's still roughly 1 in 6 companies in any given period of 5 years. So something you need to pay very close attention to. And that's where you need to have a toolkit for recognizing companies where the economics are deteriorating and a discipline to act on it once you have established that the deterioration is real, not a mere business cycle fluctuation. So a couple of examples we've had, Intel in 2020, we sold out of all of our existing strategies then. And we recognized that our initial analysis hadn't spotted how Intel's client base and data center is consolidating. And once I don't need to tell you guys this, if you go from having 1,000 customers to 3, you're going to be in a tough spot. Once we established this, we knew it was time to sell, and we weren't fussy on the way out. Because when we have a deteriorating business like this, we no longer have a map or a toolkit to anchor ourselves. And if we don't have that, we don't have any right to be operating in the shares of that company. So you don't wait for a good exit point. So we sold, and on the whole, very comfortable with that decision. In fact, not just on the whole, totally comfortable with that decision. Another example, Estee Lauder, where we recognized in the summer of 2023, having worried about it for a while, that this business had historically underinvested in its core franchises beyond our initial assessment. And we came to the conclusion that the required catch-up investment would be punitive on its earnings for the foreseeable future. And again, we took the decision to sell rather than try to time our exit. And again, so far, that's been the correct decision to make. The challenge is that capitalism is a competitive process, and companies are continuously trying to take away the excess returns on invested capital of their peers. And this leads to the dynamic that you can see in the top bar of high starting return on invested capital businesses. And this sample, by the way, I should stress, is repeated in many other studies of this type of business. So it's a durable finding. Companies with good returns on invested capital, which have them competed away, take what we call the red escalator down. And this is a punitive outcome for shareholders. As you can see in the right-hand box, it's the worst possible outcome you can get. And again, this is a robust finding. What you have is typically your earnings get worse, but also the market valuation of your company gets worse on top. Your multiple declines. And this double blow means that the returns more than offset the continued excellence of the companies that stay in that green bar. And this drives the bulk of our process. It's fairly easy, as you'll see in the next slide, to automate the selection of companies of good economics today. The magic lies in being able to discriminate between the good companies with sustainable economics and those where the economics are going to decline. And as mentioned, the down escalator piece is critical. In our experience, our hit rate, the number of companies which stay in the bar at the top, is meaningfully superior to that of the broader market. So our companies are in the down escalator at about half the rate that you see here. That's still roughly 1 in 6 companies in any given period of 5 years. So something you need to pay very close attention to. And that's where you need to have a toolkit for recognizing companies where the economics are deteriorating and a discipline to act on it once you have established that the deterioration is real, not a mere business cycle fluctuation. So a couple of examples we've had, Intel in 2020, we sold out of all of our existing strategies then. And we recognized that our initial analysis hadn't spotted how Intel's client base and data center is consolidating. And once I don't need to tell you guys this, if you go from having 1,000 customers to 3, you're going to be in a tough spot. Once we established this, we knew it was time to sell, and we weren't fussy on the way out. Because when we have a deteriorating business like this, we no longer have a map or a toolkit to anchor ourselves. And if we don't have that, we don't have any right to be operating in the shares of that company. So you don't wait for a good exit point. So we sold, and on the whole, very comfortable with that decision. In fact, not just on the whole, totally comfortable with that decision. Another example, Estee Lauder, where we recognized in the summer of 2023, having worried about it for a while, that this business had historically underinvested in its core franchises beyond our initial assessment. And we came to the conclusion that the required catch-up investment would be punitive on its earnings for the foreseeable future. And again, we took the decision to sell rather than try and time our exit. And again, so far, there's been the correct decision to make. And this is the core of the Evenlode investment process. As you can see in this chart, we divide it to quantitative and qualitative pieces. Think about it as the number of doors you need to open to get into the portfolio. The first door is purely quantitative, and it's based on the profitability and the capital intensity of the business. You put them together, you get a return on invested capital, and also the leverage the business carries. This first door, in our experience, eliminates the vast majority, 90% plus, of all companies, listed companies in the world. It's too high a bar to set. The second door is more important because you can't automate it. With competitive advantage, you are looking for an asset the company has that competitors cannot buy. Typically, you're looking at a brand, a switching cost, or a network effect. These drive economics for clients such that the clients are willing to pay a handsome premium for these products, which gives you pricing power, which drives good margins. This on its own is not enough. You also want to see 2 other things. Firstly, you want to see structural market growth. As mentioned, we are looking to preserve client capital in real terms. It's extremely hard to do this when invested in companies where the top lines are growing at least at the rate of GDP, if not faster. The other levers you have to pull to drive shareholder returns are much more limited in scope. And the second piece is the reinvestment into growth. And this is critical. The competitive advantages I just touched on don't come for free. And what you want to see is a company which is willing to sacrifice some profits, some earnings, some distributions today to assure themselves of a good roadmap in future. And the next slide touches on this a little bit. What you want to see are some of the characteristics touched on here. And they come at a price, and this is what we think gives this strategy its durability, because human beings are always fighting against our desire for cake up front. Companies which can train their management, their employees, and their shareholders to defer profitability in the interests of the long-term franchise are surprisingly rare. And the fact that it goes against human nature means that this strategy has been able to deliver good returns, not just this strategy, but this philosophy of thought going back a very long time. I'd mention here perhaps the work Phil Fisher did on quality companies many decades ago. It's a sustainable market inefficiency. And then here we have a few examples of companies which make these sacrifices and then drive attractive profitable growth over decades. Some of them are very straightforward. For example, with Linton Sprudley, you can see the investment that they make into advertising, and you can see the investment they make into having new stores, particularly in new markets, which are run at a loss, often for many years, in order to build the brand. In other cases, though, these reinvestment ones are harder to identify. And I'll give you a few examples. MasterCard, for example, has historically been very willing to rebate revenues to banks, and also to give banks, the issuers of cards, credit cards, debit cards, the bulk of the revenue that comes out of the merchant discount rate, which is the slice that's claimed by the credit card when you buy something in a shop. This revenue is very high margin for the banks and has no credit risk attached. And it's critical for keeping the banks profitable and able to deliver consumer banking. Attacking this line of investment is incredibly hard, because you would need to sustain the profitability of your partners. It goes beyond just technological capability of the things that bank card networks do, like tokenization, contactless, fraud detection, loyalty, top of wallet data, that sort of thing. Likewise, Alphabet drives the revenues and economics of a lot of their key partners, most famously with Apple. About 20% of Apple's operating profit comes from their distribution incentives from Alphabet. They also Alphabet make the Android operating system available for free to a number of their partners like Samsung. They also rebate about half of advertising revenue to YouTube creators. They're a keystone company. Hermes is another example where it's even more subtle, because there's no numbers behind it. They deliberately restrain supply of their key goods to their customers. This builds up a wait list of clients, which we think has got many years to run. This is a continued reinvestment in scarcity, which is the most valuable commodity you can have when you're talking about luxury. And then touching a little bit about how we align the company that we manage, our own company, with these values and this perspective. As mentioned, we are owned by perpetual trust, which aligns us for the long term. But again, we make deliberate sacrifices, and that's in the bottom rank. We have been deliberately restrained about the number of strategies we open. We don't have any intention of having a large supermarket of strategies. We have a circle of competence, and we stick to it. This is sacrificing some earnings, but we think it increases the duration of our business and the value of the strategies we offer to clients. We reinvest in our team and our technology. We deliberately overhire younger people, because we know that they, in future, while we have more people than we need to run the business day to day, they are our future. And the time to train them ideally is yesterday. The next best time is today. We reinvest into our technology as well to make it easier to see what we are doing. And then finally, we've soft closed our flagship fund already. That's our UK income fund. And our intention is to be soft closing over time, because we understand that capacity discipline is incredibly important to our clients. And then a little bit on the process. So I talked about the doors earlier. The first door being, are the returns good enough? The second door being, isolate the ways the company has competitive advantage, has a growing market, and reinvest in its competitive advantage. Those are the first two doors, but they're not enough. The third door is understanding the company's idiosyncratic risk. We look at how levered it is. We look at how much cash it develops out of its accrual earnings. We look at the quality of management, the cyclicality of the business model, the ESG risk, and the liquidity of the stock. This allows us to understand how much of the company would be comfortable owning in an attractive valuation environment. It's very important we make this decision beforehand, before we enter a very volatile environment. It's always important to check the parachute before you jump out of the airplane. And the final piece is the investment decision. And this is where the rubber meets the road. This is where we pay closest attention to valuation and entry points. Critically, this comes last. There's a real danger to looking to valuation and then looking to quality and then looking to risk sizing. The sequencing is critical. It's very, very common in my experience and very dangerous to look at valuation first and then back into what is a quality assessment. It can cloud and pollute your thinking. It must come last. And this is a couple of slides just outlining why we think valuation is really important. Everything I talked about in quality, that's about your ability to deliver earnings, revenue and earnings, the fundamentals of our business. But that alone is not enough. You can buy the right stock at the wrong price. And here are a few examples. This is a particularly outrageous moment we picked in the 2000s. But these are a few examples of companies where you could get your stock selection right. You could say this will be a winner over the long term, and you'd been completely correct. But you would have still lost your shirt because you bought at the wrong price. And this is an example, an extreme example, but a relevant one of why you pay attention to the price you buy at. So we've got Microsoft, Cisco, but then it's not just tech. We've got Walmart as well, and then Amazon. And noteworthily, all of them, you've been underwater for many years, well beyond what we think any investor could sustain before you made back your nominal entry point. And I'm not talking about your hurdle in terms of cost of capital, particularly your inflation-adjusted cost of capital. And then the final slide, this gets into the heart of it. Valuation matters, but valuation is incredibly hard to assess. And what we've got here are a few examples of companies which operate in roughly the same industry with very different initial valuations, but where we would be very, very cautious about taking the cheaper one. And where the more expensive one, you've been compensated for that lower valuation because, as mentioned earlier, these are all companies which have sacrificed earnings, sometimes in a very material way, in order to guarantee themselves of a longer pipeline or runway. And I could itemize some of the ways they differ. If you look at a Kering versus a Hermes, there's a cost to just distributing through your own owned and operated stores, but that's a price worth paying. For MasterCard, there's a cost to rebating so much to your partners. There's a cost to having a very large research and development pipeline, to having businesses which are currently unprofitable. But these are all prices worth paying because they give you that line of sight 5, 10, 15, 20 years ahead. The challenge is how to quantify this systematically. And we have a number of ways of doing this. Most importantly, they're applied systematically across our investment opportunity set. And that takes us to the final slide, where we talk about valuation, business, and fundamentals. They come together. I hope you get the sense going through this that this is fundamentally, there's a large element of art to this, and it's about experience. It's about learning from your experience. You do have to pay attention to the data as well. But ultimately, when we deal with companies, we're dealing with human beings. And science has got a limited amount of purchase on its own on human beings. You need to be able to marry the data to that understanding of human behavioral tendencies, bring them together, and then have that total commitment to preserving and growing client capital in real terms over the long term. And that's Evenlode in a nutshell. Talked about the alignment of the business, with our clients' interests and our mission. We've talked about our focus on the fundamentals of companies, in particular, those fundamentals which gives you better line of sight towards your future compounding. And finally, we've talked about our focus on valuation and our understanding of the sensitivity of client outcomes to your valuations. A lot has changed since we were set up in 2009. The world has become, if possible, more complex, more uncertain. Maybe that's possible, maybe that's not. Feels like it at times. Our business has become bigger in headcount, in assets and capabilities. But nothing has changed about what we do, the focus of our process and our philosophy, and our commitment to our clients over the long term to preserve and grow their capital. So thank you all very much for joining us today. I hope you enjoyed that brief introduction to who Evenlode are, what we do, and our commitment to our clients. And if you have any further questions, please don't hesitate to get in touch with Curate. Thank you all very much.
Thank you, James. The Curate Global Quality Equity Fund is a specialist portfolio focused on high-quality companies listed in developed global markets. Investors will get exposure to the quality investing style, targeting businesses that demonstrate stable earnings, strong balance sheet, and consistent performance through various market cycles. This approach has historically supported long-term outperformance with lower volatility. The fund blends effectively alongside value or growth strategies, adding resilience to portfolios by focusing on quality compounders. It's an ideal building block for a well-diversified global equity allocation.
Thank you, Ray. That wraps up our first Exhibiting Our Investment Artist webinar. We know how valuable your time is, and we thank you for joining us today. We hope that you have drawn inspiration from this webinar. Please complete our event survey that will be sent to you, as your feedback will help shape this event going forward. Until next time, goodbye.